Dear Mr. Kirch, welcome to our Value Investing YouTube channel.
It's my pleasure.
It's nice to have you here. We are in Luxembourg at the International Value Investing Conference, and today we're having an interview with you. Can you please introduce yourself to our audience?
Yes, sure. I've spent my whole professional career for over 20 years in asset management, managing funds. And in 2002, I joined a bigger institution to become co-manager of, we were co-manager of a fund from Nordea called Nordea European Value Fund, which I managed together in this team of two for 12 years, till I left in August 2014 to join a smaller boutique outfit where I try to go back to the roots of this investment philosophy outside of maybe a bigger distribution apparatus.
And two words that come in mind or that flash for the reader are European and value in your career. Why value and why European?
I think it's hard to give an exact explanation why an investor is attracted to a certain investment style. I think, on the other hand, from my perspective, it's the only investment approach that makes sense. Because quite rapidly in my career, I noticed that it's very hard to forecast or to have a precise idea on the growth perspectives of a company. So when I built historically discounted cash flows to put a growth rate on sales would be very difficult for me. And certainly also I think it has been proven that it's not academically, that we are all so biased. If a company has grown a lot in the past, we tend to think it will continue to grow this way, while there's a reversion to the mean. And on the other hand, we are very bad at forecasting this growth. So I'm not even trying to do this. Rapidly, I came to the conclusion that why, in my thinking, I'm not running these businesses for cash or for earning power, as we call it, and to see how much cash flow it can generate. It can then use to invest or to buy back shares or to pay dividends. And based on this earning power, I value then the business. That was the style. I also, reading through research, I came to the conclusion that the way of just looking at a low price to book or a high dividend yield, or in other words, the way to look at liquidation value of a business like Benjamin Graham did at the beginning of the 30s, these so-called net situations, this cigar butt investing. It's actually, first, it's very hard to find these in today's markets. And second, it's also, I believe there's a very high risk of a value trap in there. Because you can, for example, have a business that is lowly valued on the price to book, but that destroys or absorbs cash year after year. So something that is cheap may get even cheaper because actually it destroys cash. So in my world, the best way to look at these businesses is to run them for cash, to see how much does the company need to spend in order just to keep its operations running, this maintenance capex, and based on that value the business without trying to put a lot of emphasis on growth. That's when I came to how I came to value investing. What I also noticed is that while before joining Nordea, I was covering different markets and looking at globally at the world. And I also needed to be more generalist in terms of investment style. So first I thought, well, let's specialize a little bit. Let's go where the opportunities are. And if you start going to look for small and mid-cap companies, you actually need to specialize on a geographical area. I didn't feel capable to understand the Asian culture, for example, exactly enough to have an opinion on these businesses. So I was very happy when I had the opportunity to join Nordea and specialize. So it was Europe, it was value, and it was exactly the investment philosophy I was attracted to.
So let's go a bit deeper in the current situation. We're having a small crisis in Italy, and Europe
even
is not
a bigger crisis.
Even not a bigger crisis. Where do you see currently risks and chances in the European market?
Yeah, I think this, since we need to clearly understand the impact of the financial crisis. I think central banks took measures which had, in terms of quantitative easing, that had never been taken before. And that created an environment where actually there was so much liquidity available that valuations did no longer matter. So value as an investment style was no longer relevant because simply because the growth, or these growth glamour companies who are growing where the terminal value, or who are growing, create a lot of value longer with a longer time horizon, suddenly looked very cheap as the discount factor was so low. And this created a very difficult environment for value investing. I did in a column, I did a little study where I built European portfolios, where I just took the top decile of companies that had the best price momentum in the 3 past months. So I just picked up the companies without any analysis in that model. In Excel a lot is possible, that actually had the best price performance. And with such a strategy, with quarterly rebalancing, you would have outperformed every value strategy I know of, and including myself. So valuation was not relevant. What mattered was where the hype was. I think anecdotal evidence is plenty. You have Commerzbank falling out of the DAX for Wirecard, which is an excellent disruptive business model. But valuation does no longer matter here. And I strongly believe that valuations at the end of the day are a little bit like gravity to physics. It's something, it's important. So while we have as value investors been proven wrong since the financial crisis, now we have suddenly a change in the situation. We have interest rates that start to go up. Second, we also have value as an investment style, that it's so lowly valued as it has not often been in the past. So you have a trigger, and you have a good starting position for value investing. And now if we come to Europe, I think Europe has been treated to some extent lately like an emerging market. If you look at fund flows in Europe, a lot of money has been taken out of Europe, of European equities, and been flowing back into the US. Maybe the strength of the dollar is one consequence of this, but we have quite an interesting environment where valuation-wise the European market looks cheap, not only compared to its own history, but also cheap compared to, in our minds, if you look at the Shiller P or a cyclically adjusted P compared to the US. So that's a good starting point, I would think, in terms of valuation. But in the meantime, we are, as value investors in our portfolios, we are also suffering. Because what happened in the latest, let's say, turbulence in the market is that you have a lot of the technology stocks that start to feel some pressure, but on the other hand, also growth glamour stocks, but on the other hand, value is not coming back. yet. And I think yet. And that's the importance, because these are not all cyclical, dirty companies. We have pharmaceutical companies in our portfolio. We have so-called industrial companies that have very stable investment models. So this is a good starting point. Now, when it comes about political turbulence, of course, while Brexit is a theme, we invest through Europe, so we include the UK, including the UK. As value investors, we are definitely a little contrarian. So we looked after the referendum, we started to look for investment opportunities in the UK. And we invested in companies like Marks and Spencer, like McCarthy and Stone, which is a smaller UK house builder building retirement homes. Kier Group, which is a construction company, but which is without all the problems of Carillion. So Carillion had. So it's a mixture. We go where the opportunities are. We see this as an opportunity. Italy, when it comes down to Italy, I think it's an issue. I think definitely what is going on creates tensions. I think spreads are going up, bond yields are, it's a difficult, stressed situation. I think it's not good for the it's not good for Europe, I think, for the Eurozone. But I think on the other hand, if you look at we are bottom up, we look at the individual companies, there will be babies thrown out with the bathwater. For example, we recently started to invest in a smaller asset manager in Italy, which is being treated like an Italian bank, but which has a very solid business model at a very low valuation. So I think there are opportunities. However, we need to be very patient, and we are long the market. We are long undervalued earning power, which is a good thing, but we also are exposed to the volatility of the stock market. So that was a very long answer to your question, right?
It was a good answer. In the way your company, European Capital Partners, looks at companies, you have a certain lens. It's called Entrepreneurial Value Investing. Can you explain this term, please?
Yeah. For us, that's really core to what we do. And there are these three pillars. It starts with entrepreneurial. And what does entrepreneurial mean? It simply means that, like an entrepreneur, we look at the risk of an investment as something being tied to the fundamentals of this business. Because over these more than 15 years I apply this investment philosophy, it was always the case when something went wrong. It was not because we had a wrong assessment of the risk premia or the beta or the risk-free rate. It was because we didn't get the fundamentals right in the company. And equally, when something went well, it was due to the good fundamentals of that business. For us, the biggest reward is probably when a company is being taken over, we are invested in, is being taken over by another entrepreneur. And we had these cases. We had Vinko Nixdorf, one more recent examples in Germany. That was for us a proof that there is some value, economic value in these businesses, and our investment makes sense. So it's that's the entrepreneurial part. So risk is not the historical volatility of the stock price, it's actually the fundamentals of the business. And then the second layer is value. We are value investors, as I explained, to the extent that we look at the earning power of the company. We have absolutely nothing against growth. We believe growth is important, and even mathematically, if a company has a high return, or accounting-wise, if it has a high return on capital employed, if it does not spend everything as dividends or share buybacks, it will grow mathematically. So it's growth is good, but growth is, we are not trying to forecast it. or put a high weight on it in our valuation. And that makes us value investors. Then the second part is earning power. Earning power, we have a very long definition of that. It's actually the ability of a business to generate discretionary free cash flow in a normal year. Sounds very long, but in other words, we run the businesses in our model for cash. We press them out as a lemon, you could say. The juice coming out is the earning power. And if we get that earning power right, we have a strong probability to come to a good valuation. And if that valuation comes out at 100 and the stock price is at 60, we have a margin of safety. And the margin of safety we look for is 40%. So we build models on our companies. We value the business. If it comes out at stock price is 60 cents for something that is worth €1, then we have a 40% margin of safety. And this concept of margin of safety was not, of course, invented here in Luxembourg. It goes back to Benjamin Graham. But I think the idea, the basic idea is that this margin of safety is a safety net against our own wrong assumptions or mistakes, but it's also our source of return. Because if you invest into something that is priced at 60 and worth 100, you are actually, and you hold it long enough, and Mr. Market, as we call it, recognizes the underlying value of this business, you make a return. And that's the third pillar, investing. Investing for us means that, we have typically holding periods of 4 to 5 years. That's typically the time it takes for Mr. Market to recognize if our investment case is valid, of course, to recognize the underlying value of the business. So we have presented last year here at the conference, we had presented one company, Europcar. Mr. Market has not recognized a year later the undervalued earning power, but our investment thesis is still in, and we are still invested in the company. So we invest for 4 to 5 years. And then for us, investing also means that every investment must make a difference for the portfolio. So we are not building positions of 0.2%. Every investment must make a difference. So we invest in around 40 companies. It's a pure bottom-up approach. So we have our filters, our screening models to attract our attention towards companies that we analyze further. It's a clearly defined process we run through, but it's a limited number of positions. And so that also means if we want to have the freedom to go wherever we want, we need to limit the capacity of that strategy, because that's one of the lessons we learned in the financial crisis. If you want to invest also in small mid caps, you probably need to be very, very careful with liquidity risk. And that's what we do. We limit the capacity, we are smaller, we are not ambitious to become now a multi-billion fund manager on that strategy.
In this portfolio of 40 positions, how much do you put in one position? Or what's the scale of the biggest positions?
The biggest positions, when we build a full position, it's between 2 and 4%. We, of course, are not putting in 2% in one go. So, for example, we have one addition we are currently doing. We are currently trading, so I'm not going telling you the name. But we wanted to start building a position because we expected very bad results, but we wanted to sneak into it. And now, with the drop today of the share price, because the results were not so good, but our investment case is foreseeing that, we use the opportunity to buy today when markets are difficult and the stock price is down some 20%. So we go in. Then we let the positions grow. So theoretically, if you have a 40% margin of safety and you do let's say a 4% in investment, the rest of the portfolio stays flat, and you almost double your position, it would be 8%, but our biggest position is much lower than that for the moment.
And in your research process, you mentioned the word entrepreneurial. How much weight do you put on the management or the entrepreneurs in the company if you research them?
Mm-hmm. We have an 8-step due diligence process. It starts with ESG, which is, I think is becoming a very important part of what we do. We need to make sure we are respecting all the norms, and we are also not doing good, but we are respecting a minimum of, we will not invest in nuclear weapons. Or but on the other side of one of the steps, step number 8, is management. And that's part of the analysis. We think that management is important. We try to talk to management. We are, of course, a smaller boutique. It's not easy if you have a company like Unilever to go and see the CEO. But we try also at conferences to get a feeling of what's going on. And because I believe a lot in company visits, I believe in talking to management, in understanding how they react. So we spend also time in that. We are not doing it for every company because we don't have always the resources, but we do it as much as we can. There, with modern technology, quarterly conference, it's publicly available information. You have quite good investor relations now in the major companies. You get a lot of information directly from the company. So management is a part. We had situations in the past where we didn't invest in a company because we didn't get the necessary comfort on the step number 8, management.
So what are the other steps you didn't mention?
Mm-hmm.
Like 2, 3?
Okay. Well, we first start with the ESG process, and then we go through what we call proxy investigation. That's the second part of the due diligence. And in that, we look at who are the different stakeholders in the company. Does the company have super voting rights? The shares, who could squeeze us or who could hurt us as a minority shareholder? In that part of the process, it's not, if a company has a dual share structure, it's not necessarily on non-voting shares, it's not necessarily a bad sign. It's simply the sign that we need to analyze and understand to make sure that our interests are aligned as minority shareholders with the ones of the majority shareholders. And I had situations like, in the past I was invested in Trägerwerk in Germany. I think it's technology-wise an excellent company. I also believe that sometimes we have the impression that maybe it's managed for the very, very long term, but which is even a longer investment horizon than we have. and it's not a bad thing. It makes perfect sense for the family, for the Dräger family, but it may not always make perfect sense for us as investors in the waiting room. It may change. But this is an example of what proxy investigation means. Then we look at other elements like industry structure. Industry structure, that's more the classical analysis of who could, what are the Porter's 5 forces, who are the competitors, how is the competition inside, etc. And then we look at where is the company based on the value chain. Because we need to make sure that we invest in businesses that are an important part of the value chain, because otherwise they can be squeezed out. Then another point we look at is life cycle of products, because we need to make sure, take a pharmaceutical company. if you have a strongly cash-generating business, but which is facing a patent cliff, you basically already know that it will be difficult to navigate through that. You need to have an assessment on that. And then the last one, before we get to management, is the operating environment. Operating environment of the company. There we look at basically who, in terms of operating environment, what could harm the company in the short run. So, for example, how does the currencies? What are the currencies having as an impact on the business? Can have an enormous impact. If you take an example, a company like Porsche used to be Porsche in the beginning of the 90s, with the situation in the US, the Deutschmark, where it was against the dollar, almost went belly up in that. Afterwards, they implemented a big hedging program, cost reduction. But we need to understand these factors. But we are not top-down investors, so we look at it through the eyes of the company. How does the company deal with currency volatility? That's completely different than saying, I'm predicting the dollar euro for the next quarter. And then something I didn't mention yet, which comes earlier in the process because it's so ingrained in what we're doing, is the financial statements analysis. So we need to have a look at the accounting, how clean are the earnings, because what we are interested in is economic earnings. Earning power is economic profits. And so we need to have a good accounting in order to make sure that the earning power is there. So quite a lot of steps, and 8 steps, and a lot of time invested.
Thank you very much for this good and thoughtful explaining of your process. We'll be finished the interview for this now, and thank you.
Thank you.